So our results for the year ended December 2013 have just come out, and of course the most important highlight of all is the fact that we've returned to profit growth. The main drivers of this are firstly a sterling performance in the schools division, which has been the main component of the business for the last couple of years in terms of size, and has once again come through with very strong results. We're delighted that we've been able to continue growing. Revenue in the schools division grew by 11%. And at the same time, the division was preparing for the opening of 4 new sites and campuses, which opened in January this year. And if you remove the effect of the costs of those campuses, in fact, the division maintained its margins as well on a comparable like-for-like basis. So this is indicative of a business forging ahead very well. From a percentage point of view, the main star of the show, though, was the tertiary division, which strengthened its 30% improvement in earnings at half year to reach 49% growth for the full year. This is as the turnaround and re-engineering that was initiated back in 2012 following the poor first year intake that year was consolidated and strengthened, and we really began, particularly in the second half, to reap the benefits of that. The good news is that we expect this turnaround to continue to strengthen and to be sustained next year, and we look forward to a further strong improvement in the tertiary division then. In the resourcing division, the staffing business continued to experience a very difficult market, with both the volume and the pace of new staff engagements being down on what we were expecting. The business as a whole therefore suffered, and both volumes and profits were down. But nevertheless, the staffing division also produced a very good return on capital, a positive cash flow, and made its contribution to the total result. These divisional results were capped by a very strong cash flow. Perhaps one of the strongest features of our business is that free operating cash flow of 300 million was almost double the earnings of 156, and is proof positive of the strong underlying cash generation and quality of earnings produced by the group. This cash flow enabled the balance sheet to be strengthened further. We were able to see to the financing of not only the capital expenditure but all the other cash requirements of the business, and to plan with confidence for the future.